Silicon Valley Bank. I think all of us at this point have heard that they failed. It's not breaking news to anyone who's watching this video, but you may want some more information on the details. Earlier in the week, I put out a video that was basically, hey, this is what's going on right now with Silicon Valley Bank, blah, 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 all those details. But in this video, I wanted to give a little more information on exactly what caused Silicon Valley Bank to fail and to fail so quickly. And I mean, there's a lot of details that go into this. There's so many directions you could take. You could spend probably an hour just talking on one little tiny piece of what went wrong. But in this video, I just want to focus on three things. I think I can fit three things into a 10-minute-ish video. So I want to focus on their customer base, interest rates, and regulation. So starting first with their customer base, I'm sure you can tell from their name, Silicon Valley Bank, that they're based in Silicon Valley. They're in Santa Clara, California, to be exact. That's where their headquarters are. And they chose to really go after the tech industry and startups. That was their main focus. They did a really great job of marketing in that area, and that's where they gained most of their client base from. And there's nothing inherently wrong with focusing your attention on a specific group of people. We see this with credit unions all the time. And there's credit unions focus on teachers, on firefighters, on aerospace engineers. Like there's all these different credit unions that exist. And there's nothing wrong with that. So there's nothing wrong with Silicon Valley Bank focusing their energy in the tech sector and with startups. But what can cause problems is if your customer base is all affected by one big event at the same time. And that's exactly what happened with the tech industry. I'm sure we all saw from 2020 through to most of 2021 that the tech industry was booming. Like these companies, their stocks were going crazy. They were making all this money because all of us had adapted our lives to a new way of living. We were working from home. We were spending a lot more time at home. We were shopping online. All of these things really led to a big spike in revenue for these companies. And during the same period of time, Silicon Valley Bank saw their deposits skyrocket. They basically tripled over that same 2-year period of time. But all good things must come to an end, and the tech sector saw a drastic slowdown. I'm sure you all see the news stories, the headlines about the layoffs that keep coming from these tech companies. And basically, they're all scaling back. They're seeing that their revenue is not coming in the same way as it did during the pandemic. They overhired, mismanagement, a lot of different things led to this point where they're basically really slowing things down. And this also coincided with the fact that the Federal Reserve is raising interest rates. That's factor number two. I kind of weave these two together. So you have the tech industry that is slowing down, plus they're slowing down even more because interest rates are going up, which is causing the ability to borrow money to become more and more expensive. So what ended up happening is you have all these companies centered in the tech industry. A lot of them are startups, many of them banking at Silicon Valley Bank. They're finding it difficult to get funding, or at least more expensive to get funding as they want to grow, because, a lot of young companies, these startups, they burn through a lot of cash. I'm sure we've all seen shows like Silicon Valley where, they're burning through millions and millions of dollars. And what happened is they're like, well, it's a little bit more expensive to borrow money. So let's just start relying on the money we have in the bank. So Silicon Valley Bank saw an increase in withdrawals coming from their customers. So as these customers started pulling their money out from Silicon Valley Bank, what the bank needed to do was obviously come up with the cash to give these people their money, because the banks don't just hold on to the money you deposit with them, right? They're doing all kinds of stuff with it. They're lending it out. Like if you get a personal loan or a mortgage or an auto loan, credit card, that money is coming from other people who've deposited their funds with the bank. On top of that, they also invest some of the cash that they receive. So Silicon Valley Bank was in a position where obviously they can't take the money back that they've lent out. So they had to start selling some of their investments in order to get enough cash to cover this increase in withdrawals they were seeing from their customers, because banks are equipped to handle what a typical withdrawal level will be. But if all of a sudden it spikes up, it can cause problems for them, especially if it spikes up for long periods of time or for huge dollar amounts like we saw with Silicon Valley Bank. So they had to start selling a lot of their investments. Silicon Valley Bank was heavily invested in bonds, specifically government bonds. And there's not anything really wrong with doing this. A lot of banks invest in bonds. But what happened over the years as more and more money was flowing into the bank, they decided to invest in longer term bonds, which again, nothing wrong with that. But longer term bonds are more sensitive to changes in interest rates, because the price of bonds and interest rates have what is called an inverse relationship. And I'll do like a quick bond 101 here. I've talked about this before on the podcast, but you might not have heard that, or it's been a long time. So let's just do a quick refresher. So bonds are basically loans. Essentially, companies, governments, they'll say, hey, you know what? We need some money because we want to do something. Maybe they want to expand. Maybe they have a project they want to work on. Maybe some research and development, whatever it is. They say, we want some more money. And we are going to go out to the public, to investors, and say, hey, would you like to give us some money and then we'll pay you a set interest payment every year, and then we'll give you your money back when we're done. The terms of these bonds can be anywhere from, a month or two all the way up to 30 years. It just depends on what it is you're looking for. And typically these bonds are sold in $1,000 increments. So I'll give them $1,000. They'll give me interest payments every year. And then at the end of that term, they'll give me my $1,000 back. So for example, let's just say I bought a bond, 30-year bond. That means I got to hold on to it for 30 years before I get my money back, my $1,000 back. And it's paying 2% interest. I'm like, great. Some time goes by, and let's say that interest rates have gone up. And let's say that same $1,000 bond that I bought paying 2% interest now pays 4% interest. So I notice this, I see interest rates are rising. And even though I have a 30-year bond, I could sell this to someone else if I want to get out. If I'm like, you know what, I really just want my cash back. I don't want to wait another, 20 plus years to get my $1,000 back. Let me see if I can sell it to someone else. But if I'm someone out there looking for a bond to purchase, why would they give me $1,000 for a 2% interest rate when they can go out and get 4% easily? Like that would be a dumb decision to do that. But what I can do is say, hey, look, I'll give you a discount. I will charge you less. Let's say, just give me $900. You give me $900 right now, I'll give you this bond. Yes, I'm getting less money, but I've already received some interest payments, and you know what? I just want the money back now. So I'm willing to take a little bit of a loss on this. And you're like, okay, great. This makes sense for me. I'm paying them $9,000. I'm only going to get 2% interest, but I'm going to get $1,000 back at the end of this term. Now, I just made up these numbers. There's actual math that goes into determining if this is a good return on this bond, but that's essentially how it works. So what you have is a situation where Silicon Valley Bank, they have billions of dollars in bonds that are now stuck with interest rates that are much lower than the market interest rates as the Federal Reserve has raised interest rates. So in order for them to sell these bonds, they have to sell them at a loss. And I believe I read somewhere that they lost somewhere around, 1.9, maybe $2 billion in that ballpark for selling these bonds before they reached their maturity, which is like the end term. And if they would have waited to the end, that's fine. They would have lost no money. They would have gotten all their money back, all the interest payments. They would have been fine. But the fact that they had to sell these in order to cover withdrawals meant that they had to take a loss, which was not a good thing. So this kind of messed things up for them a little bit because, they didn't get as much money as they needed to cover everything. So they said, in addition to selling these bonds, we're also going to issue some new shares of stock. That's another way that they can raise some money. The problem is news got out about what was going on, about some of their struggles, and investors got nervous, and basically a bunch of people sold their stock and the price started to just plummet. This ruined their plans because now their stock isn't worth as much as it was before, so they're not going to get as much money. So ultimately, it kind of just derailed their plans in the situation. On top of all this, you have the people who have their money at this bank. A lot of them are, leaders of these tech companies, and they're pretty tight. From what I've read, they all kind of talk to each other. Maybe not all of them have one big group chat, but I guess word does spread between these groups and these communities. And there were people out there saying, hey, you know what? This bank's not looking too great. I think you should start pulling your money out. And you saw a lot of people start to pull their money out. Like the rate of withdrawals went up drastically. There's some articles I read that said that depositors tried to pull out about $42 billion, which is about a quarter of all the money they had on deposit on Thursday alone. And then obviously the next day, the regulators, FDIC stepped in and they just shut the bank down and took it over because there's just too much money. They could not handle that rate of withdrawal coming out of there. They didn't have enough cash to cover it all. And the last point I wanted to touch on here is regulation. So back in 2018, former President Trump signed the Economic Growth, Regulatory Relief, and Consumer Protection Act. And a good portion of this was seen as just like a rollback of some of the provisions that were put in, some of the regulations that were put in 2010 as a result of Dodd-Frank, which was a big, basically reform. Like this is right after the big economic collapse with the housing market and the banks doing a bunch of stuff they shouldn't have been doing, all these things. And they put new rules in place to make sure that these banks were being more cautious. They were keeping more cash on hand. They were being less risky. So that way we didn't have this big collapse because we don't want people losing their money that they're putting into the banks, right? We have to keep trusting the banking system so that way it keeps continuing to exist, right? Like that's the only way it's going to survive is if people have some type of trust that when they put money in the bank, that it's still going to be there, that the bank's not going to just disappear on them. And so one of the things that happened as a result of this act was that the law raised the asset threshold for what's called systemically important financial institutions. And basically this was like a cap. And if your bank had more assets or more, money on deposit and investments that totaled above this threshold, then you'd be subject to stricter regulations and rules. Originally, that number, before you would kind of step up to that tier where they're going to have you do a few more things to be a little more secure, maybe take a closer look at what you're doing, was $50 billion. Silicon Valley Bank would have easily qualified for that, but it was moved up to $250 billion. And so this meant that for Silicon Valley Bank, which at the end of 2022, they had about $209 billion in assets, they were no longer designated as one of those systemically important financial institutions. And for this reason, they weren't as heavily regulated and the rules weren't as strict on them as to how they should be operating. And news has come out that Silicon Valley Bank actually lobbied for these changes. So they clearly wanted less regulation, and that's what they got. But could be said that if the regulations, the rules would have been tighter as they were before and applied to Silicon Valley Bank, this maybe would have been caught earlier and they could have avoided this whole situation. I mean, that's speculation. I don't know exactly how it would have played out, but it does make sense that those rules were put in for a reason. So those were the points I want to touch on when it comes to what happened with Silicon Valley Bank. It was a lot of things. I'm sure there's a bunch of stuff I didn't even get to cover and missed in all of this, but the 3 points we're touching on was the fact that their customer base was so highly concentrated in the tech industry, which was really taking a beating based on what was going on and had their own troubles going on. On top of that, you had interest rates rising, which put pressure on a lot of these companies who were banking with them to need to pull money from the bank versus trying to get outside funding. Plus, on top of that, it caused the value of their bonds to be worth less since they had to sell them before their maturity date, as they refer to it. And then finally, looser regulations may have allowed this bank to kind of slip through the cracks and maybe do some things that they shouldn't have been doing without being caught earlier. But yeah, there you go. It's yet another video on Silicon Valley Bank. I hope this made some things a little bit clearer for you. I've probably read more articles than I want to read. I'm sure I'm going to have to continue to read more as more news breaks about other things going on in the economy right now and in the banking industry. But if you ever have a question, something that maybe you want me to cover that I didn't cover in this video, or just something in general that you want to know about personal finance, just leave a comment. I'm more than happy to tackle that in a future video. But as always, I appreciate you joining me here. Check out the Popcorn Finance Podcast. If you haven't already subscribed, it's free, obviously, but it's a nice, quick, short form podcast where I discuss finance in about the time it takes to make a bag of popcorn. I'll put links after this video, I'm sure, to the previous video I did and maybe some other stuff I have coming out. But appreciate you joining me for another video, and I'll talk to you all soon.